Hello and welcome back to The Note. Is the US stock market in a bubble? Now that seems quite an outlandish question to be asking when it's still barely 5 years since we were teetering on the brink of disaster, but stocks have been rising very impressively for a long time, and this week we've begun to pass some major landmarks. The Dow Jones Industrial Average went through 16,000 for the first time ever, and the S&P 500 went through 1,800 for the first time ever. So, could this really be a bubble, and how would we know it if it was? With me now to discuss this is the past president of the New York Society of Securities Analysts and president of Blue Marble Research here in New York, Vinny Catalano. Vinny, thanks very much for joining me today. How would we tell if this was a bubble? How do you define whether when an overpriced market has become a bubbly market?
Sure, that's a terrific question, John. It is difficult to identify exactly what a bubble is. There are certain metrics that you can rely upon. A number of them deal with price-earnings ratios, other ones deal with equity risk premiums. They're all tied in with interest rates, and they're all tied in with a reasonably subjective, only somewhat objective tool, which is valuation models.
Okay, now let's take a look at one very popular one, which is associated with Robert Shiller at Yale University. It helped win him a Nobel Prize a few months ago. What would you say was the message from cyclically adjusted PE ratios, from long-term valuation measure like that?
I think the chart shows pretty clearly that while stocks are not at a screamingly attractive level, neither are they in bubble range. Bubble range is being identified as some of the previous periods, like, for example, the tech bubble. But having said that, the level, according to that metric that Mr. Shiller has created, is comparable to, let's say, 1966 here in the U.S., and that was a peak in the U.S. market at that time.
And would you get the same kind of measure from the equity risk premium associating earnings yields with bond yields?
You're getting close. You're not quite there yet, because the range and the metrics that I use say that we're getting close to the normal range. The normal range being an equity risk premium of around 2 to 3%. And there are various different other equity risk premiums that are out there. My measures use it at a 2 to 3% range. We're just above 3% right now.
Okay, so expensive, yes. Screamingly, dangerously bubblicious, no.
No, right.
What is intriguing, though, is that this is probably the most hated bull market in history. Plenty of my readers have pointed out how negative I've been about it over the last few years. Obviously, there is great pessimism still out there amid the populace. Are there any reasons not to trust this market? What are the big reasons for doubt?
Oh, I would say that there are plenty of reasons to be concerned about the market and even mistrust it. One of them being why the economy has been able to perk along the way it has: central bank action. The central banks flooded the system with liquidity, not just here in the United States, but all around the world. We're all around zero interest rates right now. Their balance sheets have exploded. And that's incredibly problematic, because how long can that go on for? Various different well-known commentators have made remarks in that regard, and I join them in concern.
Okay, and I suppose one thing, we're showing a chart here from McKinsey, not known for being socialist egalitarians. A chart from McKinsey showing the redistributional effects of QE. This is very painful for long-term savers, even if it helps the government. I mean, is that another reason for caution?
Yeah, absolutely. That's part of the whole distortion, what they call financial repression. In other words, you've got artificially depressed interest rates. They're distorting all range of issues, including forcing many that are ordinarily investors in more conservative type of investments, like interest rates and fixed income vehicles, pension funds, etc. Well, they're forced to go into higher risk investments. And that leads to problems ultimately, or at least it has in the past. And if it continues, yeah, we're looking at something that'll evolve into a problem here too.
Okay, Vinny, thank you very much indeed. Reason for caution, plainly, but no, this isn't a bubble, and I think perhaps the biggest reason we can be confident it isn't a bubble yet is that so many people are worried that it's a bubble. When there's a true bubble, like back in 2000, people think it can go on forever. Nobody seems to be quite that optimistic now.